Welcome to the Wealthtech podcast. Julian Shillinger, CEO of Privé Technologies, and also a very experienced, almost banker with initially an RO license, SFC license. Not sure if you hold it still, but very experienced in the market. No more. Okay. No, great to have you. Thank you so much for joining the podcast. And you know that we normally start with an icebreaker. So tell us something about you that makes you you.
So first of all, thanks for having me here. I'm very excited to be on this podcast. Well, maybe something interesting about me is that I try to brew beer. Actually getting better in brewing beer. It's sort of because I'm from Bavaria, the south of Germany, and I sort of do it out of cultural responsibility. And we actually recently even had a beer brewing event in the office, because my wife was uncomfortable with all the beer brewing equipment at home. So I made it a team event, and now even got the engineers working on the automation of the beer brewing process, including myself. I like to program stuff and build hardware. So that's what we're doing. So
Nice.
Next time we're brewing, you're very welcome to drop by and
I would like
brew
to.
it together.
I mean, I have to admit that I don't drink alcohol anymore due to sports running.
It's just
But
beer.
we can exactly. There's also the alcohol-free version. But I actually did once brew at the university I'm coming from, ETH. They had their own small beer they were brewing, one of these alumni groups. And maybe people also realize actually our accents. We're both not from an English native-speaking country, Germany, as you just mentioned in your case, and Switzerland. So actually Bavaria is not far from our area in Zurich. So good to have you on board, Julian. Coming back to your journey here in Hong Kong, you didn't start immediately as a fintech entrepreneur. You were working for some big financial institutions. Maybe you can quickly share. You were a licensed RO even in SFC Hong Kong.
Yeah, that's correct. So actually, my background has been always on the technology side. I learned programming when I was 11 years old, which back then was sort of a crazy idea. And I always liked to work on technology and these aspects. I studied business computer science, which is sort of the combination of IT and the business side of things. And then started my career with JP Morgan in Hong Kong in 2005 on the rates derivatives desk, mostly building quantitative investment strategies and structuring and building these financial products, which interestingly is actually quite similar to engineering. So if you engineer a system, which is a piece of code which takes an input and produces an output, or you build a quantitative index, both of these things have logic, they have formulas, you need to test it, you need to run it. So there's a lot of similarities in that. And also, there's always a selling part to it, right? You need to understand what your client's needs are, and you need to position the product, change the product, and make it possible for them to understand the benefits of using that product. So while I was working there more on the financial side as a licensed representative, subsequently I was working in life settlements, which is longevity as an asset class. So you can bet on interest rates, you can bet on equity indices, but you can also basically take positions on longevity risk. You can do this through buying insurance company stocks as well. They also have exposure, but there's also a way of basically doing that through an asset class called life settlements, and that's where I also was RO running the Hong Kong and Asia business for one of the big providers.
Understood. And of course, I'm sure everyone is now keen to know why you moved into basically founding your own company together with your good friend Charles, who also, I think, comes from a banking background. What's driving you?
Yeah, so I met Charles at one of my first internships at JP Morgan, actually.
Yeah.
And Charles has a background, he's from MIT. So we both sort of shared a passion for the technology aspects of it. But what we did realize is that when we were speaking to financial institutions, when we worked at JP Morgan and other financial institutions, that these financial institutions would then redistribute the product to high net worth individuals or mass affluent or sometimes retail clients, that their selling process historically has been more based on selling the most expensive product or the highest commission product to the client. Now, with the financial crisis, that all changed. They had to rethink about how they're approaching it, because if you look at things like the mini bond scandal, where there were certain collateral inside the product, which ultimately was linked to many of the entities which went under during the financial crisis, the risk got stuck with these distributors. They could not say, oh, well, we bought it from these investment banks. Now they need to pay back the money. The SFC was very clear. So you need to, and the HKMA was very clear, you need to make sure that these clients end up not losing their shirt. And that sort of set on that whole rethinking in the industry, that how do we advise a client in a better way, make this also a more robust client portfolio, and at the same time, we make this in a more efficient way so we can still make money as well. So we saw this rare opportunity of a win-win-win situation where you could help the financial intermediaries, the financial industry. You could help the end client for getting a better product, which is more diversified and better monitored. And also we could make some money as well, which is helpful as well. So it's quite rare, because most of the times in economies, you've got a zero-sum game. Like, I make money, but you're making less in return. So if you look at the stock market, at trading, that's pretty much how it works. Versus that was an opportunity where everyone can benefit. And we kind of like that. Together with our, interest in technology, we saw that opportunity to bring everything we learned about financial products, quantitative strategies, analytics, the wealth management process for advisory and discretionary mandates, and how we could bring that and put it into a technology program, which ultimately help financial intermediaries to empower their relationship managers and investment consultant to bring a better service at a lower cost to their clients.
Yeah, and it's interesting as you really combined both the business side as well as technology with a technology background. I think it makes it also much easier to advise bigger financial institutions if they want to buy a solution, a Wealthtech solution such as yours. You've been now also in fintech, Wealthtech, 15 years, I believe, almost.
Yeah.
Which is one of really the first ones that entered this space. And I, of course, appreciated always also the collaboration we've had, and always saw that you really understand also the business and the technology side. I would love to start with a bit of a backward-looking view on where Wealthtech was, and you mentioned before advisory, discretionary portfolio management. Maybe you can also then quickly say a few words on how this may also differentiate in Asia, especially Hong Kong versus Europe. Why there was maybe also a niche to play, and how it evolved in the past 15 years, as you've really seen it all. And then later we can look into, of course, where it will head towards next.
Yeah, absolutely. So, we generally differentiate between two wealth management processes or products. The one is advisory, where you basically go to a client, you recommend him a trade. You're saying, oh, buy IBM or buy the structured product or sell this. And you make the money from the commission of that transaction. And on the other hand side, you've got what's called discretionary, which is more like an asset management mandate. The client says, well, here's a pot of money. These are my preferences. This is the investment manager strategies I prefer, but you manage it for me. And what you've seen in Europe, discretionary was always a much larger portion of the mix. And with the regulatory changes like MiFID II, it became so expensive to do advisory, because for every trade you had to write this essay of why you recommended it and why this is good for the client and which alternatives you considered. And that got introduced already quite a long time ago. So back then you didn't have Gen AI to write this for you. So it basically meant that the whole market moved into discretionary. There's another reason though why in Europe this is also the more palatable product, and the reason is that generational wealth transfer happened much earlier than in Asia. In Asia, most of the wealth is much newer than what it is in Europe. Now, the first generation, and especially in Asia, they are mostly entrepreneurs, and they are used to make all these decisions themselves. And you became a successful entrepreneur by making the right decisions many, many times. So you naturally assume you're going to make the right decisions on investment products as well. Whereas in Europe, it was already for a very long time the second and the third generation. And they were not the ones who built the wealth, but they wanted to manage it. Or they were professionals and they wanted to focus on work, and they let other people manage the money. And then during the dot-com crisis, a lot of people who were trying to sort of bet on specific stocks, they lost their shirt as well. So there was that element too.
And sorry to interrupt, but sometimes people say, oh, there's more gamblers in Asia. But what it actually means is exactly what he said, that they are new entrepreneurs, really first gen, and but also very knowledgeable in complex products they want to also invest in. And
Right.
I think that you see still a more variety of investment solutions in Hong Kong, Greater China, than what you probably see in Europe. Not that they don't have it, but in a very low volume. Am I right to say?
Yeah, absolutely. So in Asia, the process has been a lot more on the advisory side and less on the discretionary side. But we see the discretionary element is growing quite nicely.
Yeah.
And that's, for one hand side, sort of in the private banking side, where you deal with single securities like buying and selling stocks, bonds, and structured products. And increasingly people want the bank to manage that, or at least a portion for that, or they mix it. And the second part, what we see is a lot of the mass affluent wealth in Asia sits in mutual funds. So now if you put yourself in a financial institution, if you own mutual funds on behalf of your clients, you advise them on mutual funds, the problem you have is that that product is to a certain extent interchangeable. So you have a financial institution across the street who may offer the same fund. So it's a little bit hard to basically prove that value to your client. And now with everyone being online, that became even more transparent. So what we can offer for these people through discretionary portfolio management, you can say, oh, I want a BlackRock strategy, for example, but I want it personalized to my specific needs, and I wanted to replicate and buy and sell the underlying stocks and bonds in my portfolio, but I want an ESG overlay. I'm okay with alcohol, but not weapons, for example. Or I want to limit my Europe exposure because I feel more comfortable with Asia. So through these, basically what's called SMAs, segregated managed accounts, you can take an investment manager strategy, but you can personalize it for the client. The client doesn't hold unit in the fund. Instead, they hold direct shares and bonds, which sort of reflect that strategy. And you build a more differentiated product for your clients, which you can personalize for them. And that's a huge factor, because that personalization historically wasn't such a big theme. But now with everyone's, even like on retail side, everyone's used to Netflix, right? You go on Netflix, you tell it, well, these are my preferences. These are the movies, these are the genres I'm interested in. It comes up as this curated list for you, or Spotify, or Amazon.com.
Yeah.
Now, in finance, you need to find the right infrastructure to offer a similar experience. Clients take that for granted. They do not just want model portfolio 1, 2, 3, 4, 5, and then sit there and have no influence in how that is being managed.
Yeah, now we have the special situation that actually in the past few years there is the Magnificent Seven, or the previously called FANG stocks, the top tech and AI chip stocks in the US that outperform all markets, and people just feel like, hey, I only need to invest anyway in those 5 to 10, or maybe just buy a VOO ETF to just resemble the market index, for example, S&P 500 in the US. Why do I need a complex portfolio management system? It's all done, and I can use my interactive brokers to manage this. How would you counter also, and especially for maybe more complex high net worth individuals, but maybe also the mass affluent, why it should not be as easy, and how then also a Wealthtech solution such as yours can come into play to manage the complexities you you elaborated on.
Yeah, absolutely. I mean, you're completely right. I mean, the problem with the general advisory business is that people gravitate and feel more safe about things they know well. But there's only so many things you can know well, right? So any financial professional, that applies both to the advisor and the end client, there's certain areas where you're super expert, but there are other areas where you're not. So now that bias of believing that things where you're an expert in is also a safer choice may not always be true, because in that solution space, you don't see the other parts. So now this modern technology, and I mean, I'm using the old buzzword of big data, which now is sort of morphing big data plus AI. First of all, this big data and then the analytics and the AI on top, you can analyze a lot more investment options for the clients, and you can tailor it a lot more to what their specific needs or biases are, by visiting and exploring all sort of different options beyond what a single financial professional could even phantom in their head. It's always how many balls can you juggle at the same time. And I don't see this necessarily that that's replacing a relationship manager or an investment counselor, but I think it puts them sort of on steroids. It allows them to sort of be sort of that, we always call it the Bionic advisor. So half machine, half human, the Robocop, if you want to put it like that, who has that ability to explore all these options and give the best advice to the client. I do still believe that clients, for quite a large segment of the market, will still want the human interaction. I think there's a pocket which the whole technology can be done completely direct to consumer, and that is something where we're providing as well, live for clients. But there are always some clients who also want to speak to a human still, and how do you make sure that human is perfectly informed and can support the client without having to spend days of research? Because if that happens, if he needs to spend days of research, you're cutting out, or you're lifting the bar of who you can service to only the super rich at 20 million, 30 million, 50 million plus. And that is actually really, it's sort of unfair, because that means the super rich will get very good risk-adjusted returns, and everyone else will get less risk-adjusted returns. So even if the income disparity goes away, the richer you are, the faster you will get richer than everyone else as a percentage of your wealth. And I think there's sort of that element where this democratization kicks in, where you can service a much larger population really well through the use of big data, AI, and technology.
Yeah, before we come back to AI, and I have a lot of questions there for sure. And I'm also keen about the fact that it's a big trend right now. Coming back to, I mean, your solution is addressing also B2B financial institutions, of course, in Hong Kong, Singapore, that are quite mature, but also in emerging markets. Some of them, as I said before, even addressing the mass affluent market. You talked about democratization of wealth, especially the ones that just became more rich and but not yet maybe as knowledgeable in really financial services, trading and investment. Maybe you quickly elaborate if a financial institution wants to really build that bionic, or in the past called robo-advisor, maybe human supported still. I fully concur with what you said in your statement, that there's still a human interaction that many appreciate. But if someone wants to build this, what is maybe the pros and cons of either doing it themselves versus buy maybe also solutions such as yours or any other in the market?
Yeah, it's a very good question, and it's actually a very interesting one. So when I was in my teenage years in the 90s, there was this whole attempt to use IBM OS2. And actually IBM worked on that together with the banks. So the banks had an ambition to at least have a large say in how an operating system would work. I mean, they didn't attempt to build their own CPUs and put their own hardware together, but they were certainly sort of that understanding from the technology stack that they want to be involved in every layer. I mean, ultimately, it's a technology-heavy and data-heavy business. It's always been. Now, what happened then, like Windows took over and so on. And we saw the similar aspect of like when the cloud solutions came out, which sort of take a lot of work out of the bank's data center and basically putting it on a broader platform with more compute power and more flexibility. There was always that hesitation to do that. And now sort of the infrastructure layer, I think all major banks are using the likes of Amazon and other web services provider.
Mm.
Now, the next evolution is sort of that application layer, where also historically there's been sort of that attempt to build all these things yourselves. And until today, some banks are having a stronger propensity to that, build versus buy. But even there now, the problem is your time to market and the way you need to be in the forefront of all innovations. It may not always be the right decision to spend 3 to 5 years and with a lot more money to build it yourself. I always give an example, because when we first started to work with banks, the first question they asked us, well, couldn't we do this ourselves? And I said, well, if you have enough time and money, you can fly to the moon. Sure, you can set up an Apollo program, but the question should be, does it make sense for us to do it ourselves? Because we build it once and we sell in a highly configured way, so the outcome is different, but the underlying base layer is the same for all of our clients. They're all on the same version, on the same operating process around the global data centers. And they have highly configuration, so what their clients get is quite differentiated. But now, increasingly, because of their pressure to get live fast and the budgets are not in the hundreds of millions, there's a lot more propensity to basically buy these components. So what you see, the tier one players, what they're doing, they're keeping the aggregation layer themselves. So they're saying, we're the app store. We don't build every app. Maybe we build an app here and there or build an interface there. But we as an organization are like the app store, and we get the components from different providers in the markets, and then we tie it together to different journeys for the different solutions to the end clients. And on the tier two players, they're increasingly looking for end-to-end solution, where they're saying, okay, from onboarding to risk analysis to rebalancing to fee calculation, both for advisory and discretionary, for my D2C and for my advisor-driven channel, I want one platform. So similar to what a Salesforce does for marketing, we're doing sort of that for the wealth management industry. And you can still configure it, but there's sort of a base product you can get started quite quickly.
Yeah, and as you said, it of course depends on tier one bank versus smaller investment managers. But I always try to use this analogy to other industries. I mean, there's almost no car manufacturer anymore that actually produces really a car end to end.
Absolutely.
I made that statement in the past. Nowadays, there's Tesla that goes back a bit to do more again themselves. But the other industry you could look at is even chip manufacturing, as we talk AI. There is almost no CPU or a chip anymore that is doing the whole chip manufacturing, where of course TSMC in Taiwan is doing a big part of the actual research and development of the chip, and then of course have the assembly, and there's multiple companies involved too at the very end. NVIDIA or Intel of course put things together and sell what we see as the end product. So definitely going into a direction, what you said, also really buy and put things together. And of course, towards the end client, trying to bring their own individualized journey. Brings me back to the AI topic we briefly touched on, but going into more detail. The role of the relationship manager, the human touch you mentioned before, and call it your Bionic advisory. How is that going to change now with this rapid development in AI, Gen AI specifically?
Yeah, so first of all, AI has been around for a long period of time. Coming back to my teenage years in the 90s, I was trying to train neural networks. I mean, they were like very small neural networks on my home computer. It was very limited success to come up with something reasonable, but the base technology, how this works, has been around. And AI is not just machine learning and neural networks. There are also other evolutionary algorithms, for example, like genetic algorithms, which we use a lot. So we got patents going back to 2015, 16, 17 in this area. How can we do this hyperpersonalization of a portfolio for a client which has very different and sometimes difficult to express needs, so emotional needs or personalized needs. And we've been using that technology for quite some time, very successful with clients. Now, the difference with Gen AI or large language models, it brings that explainability layer and that data mining layer of not structured information to the equation. So let me give you an example. Our AI portfolio construction engine would take a CIO view, a house view on asset class allocation into account. It takes your regional preferences account. It takes your ESG preferences account. And it does this Darwinistic part of their portfolios. Basically, the stronger they are, the more likely they pass the genes to the next generation. I basically have children, and the weaker ones, they die. So that's how it comes within a couple of seconds to very good results.
Yeah.
But now the problem is, now you're the RM there, and you're like, well, okay, did all that, but how do I explain that to the client? And that's where XAI, explainable AI, comes in. That's where the large language models come in, because they can read the commentary to the CIO view, saying, well, the CIO said overweight Taiwanese chip manufacturers, for example, because that was his rationale. Now we are overweighting that in the portfolio. You can do sort of factor analysis, and then you can basically put that script and the bullet points out for the RM, which he can rely on to explain it to the client. And it comes back to the point before. It makes sure that knowledge bias, that I only focus as an RM or as a client on the pieces I know, because I don't want to talk about things I can't explain, that gets eroded. And that ultimately is good, because nobody knows everything, but this can sort of condense and give the right pointers to train people, but also to give them the right information, which they need to explain it. And financial products are products which always have something to do with trust, and they always need to be explained. It's a consultative selling process to sell these products. Nobody wakes up in the morning and saying, let me go to a portfolio review. That's like going to the dentist, right? So that element is always there. And if I can make that process more efficient, and if I can make it qualitatively better by avoiding these biases, then ultimately I'm doing good for the client, I'm doing good for the financial institution, and everyone wins.
Yeah, it's a great world we currently live in, seeing those developments, but also sometimes almost frightening as it's so rapid. So maybe let's touch on, are we talking about that actually the AI support, for example, an RM has a much easier job to also do the disclosures of the chosen product in advisory towards the client, but also go a step ahead in a sense of the client directly, using even without the human touch, direct robo-advisory. Do you see a path to more, maybe even replace RMs completely, and then clients will just use the AI agent or robot they talk to and get the information themselves, and then it's just a platform executing?
There's always been that segment, right? I mean, that's not a new segment. So if you go back to the introduction of the fund of fund, which I don't know, probably happened in the mutual funds, came up 60s, 70s, fund of funds somewhere in the 80s, 90s. If you walk to a bank branch and they didn't know what to sell you, you always got a fund of fund, risk level 1, 2, and 3, and 4. And somebody was managing that. And that was your robo-advisor before there was the robo-advisor, because it's a fund wrapper which you buy and it just does something. You don't need to worry about it. Now, that's highly unpersonalized. It's sort of a cookie cutter approach. Not the best outcome for the clients, but it was a product which didn't need a lot of hand-holding to be sold, if any. And it was available for a long period of time. Now,
sorry to interrupt, but you said it's not the best outcome for the clients. Maybe you can quickly touch.
Because it's not personalized. And there's some layers of fees in there. So it's an efficiency part, a fee part, and it's not personalized. You cannot, I don't know, it's like if I go to the supermarket and I have 5 shopping baskets pre-prepared for everyone. The one is like for person no kids, the other person with 2 kids, and the other one was a wife and 2 kids. The probability that that's exactly what they wanted to buy is very low, because everyone is different.
So that's one element, of course, the bespokeness, and we'd love to hear more about it. And the other one, you just mentioned the fees. I think at least here in Hong Kong, everyone has MPF, right? Government fund, retirement fund, where you can allocate, of course, your funds into the respective mutual funds provided by the different MPF providers, and it's probably 100 to 100 funds, not that many, and there is a lot of hidden fees exactly behind, because there, of course, there's effort to set up these funds and the whole platform, which I think in Hong Kong is not the most efficient compared to other markets. But these fees could be avoidable with also a better platform and maybe more bespokeness. But if it's too bespoke, then we come into, of course, cost to serve for the ultra high net worth, which of course comes also with a cost. So there's a thin line on how we can optimize in terms of efficiency and cost, and how much you want to go into probably bespoke. But I guess, and sorry when I interrupted you on that point, that's where also AI can help.
Yeah, but that's basically what you see. You've got, in the old world, you've got layers and layers of fees stacked on top of each other.
Yeah.
And it's not personalized. The new world is many of these layers are being taken out. The clients own, partially also what we do in Europe, is fractional shares, the underlying securities directly, and it's personalized. And then the whole part about how to allocate, how to efficiently rebalance, that you can do with the traditional AI, basically, tools. And then you've got the whole explainability part, which you can automate through the large language models, generative AI. Now, what you said is quite interesting. So there is increasingly possible to serve a larger segment without relationship manager involvement over time, because I can give them increasingly a service which is similar. But what you see also is that then these relationship managers have more time on also looking for new clients, right? I mean, there is a sales aspect to that job as well, which is not necessarily bad for the client, because a lot of clients, so for a big bank, the way it works is ETB, existing to bank, and NTW, new to wealth. It's basically a lot of people sitting in cash, which in an environment where you still struggle a bit with inflation and where interest rates starts coming down may not be the optimal choice. So freeing up them to have a conversation about why they shouldn't be sitting in cash and why something else makes more sense for them, it's actually also good for the financial institution and the end client.
So coming back to hyperpersonalization then, I mean, of course, I understand using all the knowledge and so on to also make it better understandable, disclosures and so on. But how far can we go in terms of really making also that basket more suitable to an end client?
So there's a lot of aspects to this. So one is using like genetic algorithms and other or reinforcement algorithms to basically build a basket which most optimal matches, which is the most fittest choice for a client based on a number of fitness factors. You're a runner, so
yeah.
So your fitness factors are how well you run in the climb and how fast you can breathe. I'm obviously not a runner, so I'm just guessing. And how good your sun protection is and all these kind of things, and how much water you carry and how much water you need. And just like that, you can personalize your training, you can personalize your equipment, how you set up, at what day of what time of the day you start your run, and how you break down your brakes. You can optimize all these complex parts, and something which sounds so simple initially becomes this highly multi-factor complex analysis. And that's sort of the quantitative part we can do. Now, the other part which is interesting is how do you mine from a target client? How do you mine what they're actually interested in, right? How do you pre-populate this and get away from the questionnaire that questionnaire and these questions you would have to ask are already being extracted and at least pre-populated based on email correspondence, on similar clients with similar situations, so like a cluster analysis. And how can you sort of put the input, how you make that more intuitive and automatic. And then the part is, once you build the portfolio, how do you explain it? And that obviously then goes also when you maintain it and rebalance. Once there's new money available or once it takes money to go out, that correspondence and that explanation can be automated. Now, from a regulatory perspective, this is still sort of taken with a grain of salt. And there is I would say, a cultural issue behind all this. If my RM has read about some specific stock or mutual funds and explains it to me, and he makes a mistake, not in terms of he misrepresents, but he may come to the wrong conclusion.
Yeah.
They always say the art of research is to explain tomorrow why you're wrong today.
Mm.
That is acceptable. It is accepted that somebody who says, oh, Trump is going to put in tariffs and hence you should be selling this or buying this. And it turns out Trump puts in tariffs and maybe the forecast hasn't held. Then, okay, well, something else happened. And that's why that logic chain which was applied hasn't proven itself.
Yeah.
Now, the problem culturally we have with machines, if it's not a human doing that research and giving that advice, if it's a machine doing it, historically a machine was never allowed to be wrong.
Mm.
You can have wrong inputs, right? If you have the wrong market data, that's garbage in, garbage out. Everyone understands that. But it's not allowed to come to the wrong conclusion. So if the machine says, if Trump puts in tariffs, then that's going to happen to your portfolio, that's a complete different game. That's why there, regulatory-wise, has not been a proper understanding there, or not a proper guidance on how to deal with these cases. The regulators said they want a gray box that at least it can be explained why the machine has decided in a certain way. But we still see that there's quite a bit of hesitancy from the financial institutions to release that Gen AI large language models, which can sometimes also hallucinate, directly to the consumer. We see them adopting it to support the relationship manager and the investment consultants. We don't quite see them yet fully throw it out in the sort of the robo-advisor or the automatic advice in that sort of free-flow way. So what we see there is that the system generates pre-canned responses which apply to a certain segment and saying, you guys should be selling Apple now because of the tariffs. I'm just making it up. And then the Gen AI says, okay, for that cohort, this is the text I propose. There's a human who says, yes, that text makes sense. And he puts a little note, yes, I checked that. And then that's being incorporated in the messaging to that cohort, which has that position, for example, or who would benefit from that position. And that will take some time until regulators and financial institutions and clients are comfortable enough to develop that level of trust to a machine.
Yeah, and even if you take some of these large language models and you use it and apply it in just generating a picture, for example, show me a warrior 1500 years ago in Rome, and there is some DIY bias applied, and suddenly you realize actually that it doesn't even come close to it. But while training those models, there was a certain bias applied, and of course that should never happen. And in a very important financial decision.
And every model is biased, right? You train a model on data, and that data by nature is biased. I'm not even saying on purpose, but it's always skewed in some way or not.
Yeah.
But it's always been true with any data, right? So if I train my model on, I'm just conversing, so I train my model on identifying the best mutual funds, while the worst mutual funds who always underperform, the hedge funds, they're no longer part of my training set because they're closed down. So you have that survival bias, and you have many other biases in any kind of data. So I don't think the approach can ever be that we expect an unbiased model. And unbiased would mean to decide what's the bias, and that becomes a political debate.
Exactly. Very interesting. I mean, I would love to discuss this much, much longer, but we are more or less at time. Appreciate it, really. Before we wrap up, though, is there anything we'd like to share? Maybe also where we can find you and any information about Privé Technologies?
Yeah, I mean, you can just find me on LinkedIn, Julian Shillinger, or any of my colleagues, and the website is privétechnologies.com. We also typically attend a couple of conferences across the year, and including the Singapore FinTech Festival. So that's also where you can find us. And probably if you ask around the industry, you will find good reference cases for us. Financial institutions are always a bit shy of doing big press releases about their vendors. But I think we're servicing quite a few of the large ones, and they're very happy with us. I mean, we talked about a lot about these aspects around what's the future, what's the latest innovative technologies we apply, and we do all that. But then there's also sort of what I call the boring but quite difficult piece, which is how do you make sure you deliver exactly and manage exactly what the client expected, and how do you implement it, how do you test it. There's a lot of operational process to get a system live in a regulated context with a financial institution, which sort of takes these years of experience. We started in 2011 to learn about that implementation process, and I think you guys are experts in that as well.
Yeah, and I mean, it was just about that time that I also came to Asia, and we know each other now since a long time. And you are actually well known in Asia as an expert, but also meanwhile more globally, as you also operate in Europe, of course. So great to have you here, Julian. Thank you so much for your contribution. And to everyone else, please like and subscribe the Pulse Check podcast with Julian, Privé Technologies today.
Perfect. Thank you so much. Thanks for having me.